The policy director of the Economic Growth Program at the New America Foundation. And we're lucky to have today Dr. Thomas Palley, a leading economist in the Washington area. He has an MA in International Relations and a PhD in Economics from Yale University. He's a former assistant director of public policy at the AFL-CIO, founder and director economist for Democratic and Open Society, former chief economist, U.S.-China Economic and Security Review Commission, and a research associate at the Levy Economics Institute of Bard College. It's a particular pleasure to have Dr. Palley here today because we're seeing a revival of Keynesianism, or at least what purports to be Keynesianism, after a generation or two in which quite different economic models held sway. I say what purports to be Keynesianism because there's been a tendency within the economics profession and among policymakers to identify Keynesianism solely with the idea that you need counter-cyclical spending in recessions, and sometimes you need a massive government spending to boost aggregate demand. And of course, Keynes's critique of conventional neoclassical economics was much deeper than that, and goes to raising questions about whether the very model of a stable, harmonious, self-equilibrating economic system has much traction in the real world. In thinking about how I would introduce this particular talk, I thought about the old Perry Mason episodes. I may be showing my age, but some of you remember, where at the halfway break, under cross-examination by Raymond Burr, the suspect would jump up and shout, "Yes, yes, I did it." And then in the second half of the show, Perry Mason would establish that the suspect thought he had killed the victim, but actually had not. He had merely knocked the victim out. And then another suspect came in and actually, did the coup de grace. And so I think one way to think about the debate about the crash of '08, as I just like saying the crash of '08, the crash of 2008 and the subsequent crisis, depends on how you answer the question of who done it. Was this primarily a problem of the financial regulatory system? And is this primarily a financial crisis? Or was the financial crisis itself the symptom of an underlying macroeconomic imbalance within the global economy? So I think that rather like Perry Mason, Dr. Thomas Palley can help explain to us today who done it. Please join me in welcoming Thomas Palley.
Thanks, Mike. That's a great way of framing what I'm going to talk about today. But first of all, I'd like to thank Cheryl Schweniger, who unfortunately can't be here today, who's one of Mike's colleagues here and directs the economics program here. I want to thank him, first of all, for inviting me to write this paper on behalf of New America Foundation. But more importantly, I want to thank him for his helpful comments, because this paper is a lot better for the comments that Cheryl gave me. I do think that Cheryl is one of a couple of three people here in Washington, D.C. who really do understand what's going on, understands the economics, the politics, and then laces it together in a coherent political economy. So it's too bad he can't be here, but still like to thank him. So let me see. Let me just make sure if I can get this going. Where do I push it? Which direction do I push it in? Let's see. That works. And back again. Yeah. Oops. No. No, how do I go back? I'd like to know how to use the technology. That goes back. Great. Well, that's big forward. Well, it's widely agreed. Let's see. That the current crisis is tied to the bursting of the house price bubble and the debts that were accumulated in financing the bubble. And as a result, most commentary, if you read the newspapers, has focused on market failure in housing and credit markets. Now, what I want to ask today and suggest today, let's ask the question, what if the economy needed a bubble to ensure growth and full employment? That's the question I'm going to ask. I'm going to put some evidence in front of you. And then, if that is the case, that would then imply that the really deep cause of the bubble was the macroeconomic structure of our economy. And a focus on market failure, which is what we have today, would completely miss that. Now, the problem that I see from a policy point of view is that there is really quite a deep resistance to recognizing the macroeconomic causes of the bubble. And I ask myself why. Well, one reason is that individual market failures are specific and easy to understand, whereas macroeconomic forces operate slowly, cumulatively, and indirectly. A second reason, I think, is that market failure offers a very clear and concrete fix-it agenda that is especially appealing to politicians. And the third, and I think the most important reason why we can't get sort of the macroeconomic arguments on the table, is that a microeconomic focus does not challenge the broad structure of economic arrangements, whereas a macro focus invites controversy by putting these issues squarely on the table. But what I'm going to argue is that, put simply, a crisis of the current magnitude, and it is an enormous crisis, it's the deepest economic crisis since the Great Depression of the 30s. A crisis of this magnitude does not happen absent macroeconomic forces. And that means to understand the crisis and to identify the needed policy changes, we have to understand its macroeconomic roots. And for me, the number one policy challenge is getting these macroeconomic arguments onto the policy table. And I'm going to argue that there are two critical macroeconomic factors involved. The first is a flawed US growth model that we have adopted sort of since really around about 1980. And the second is a flawed US model of global economic engagement. And the structure of my talk is going to be, I'm going to first develop the arguments about a flawed US growth model, then I'm going to turn and develop the arguments about our flawed nature of our global engagement, and then I'm going to put them together and show how when you have this combination, the chickens came home to roost, so to speak, in the form of a crisis. Now, one of the problems is these macroeconomic forces that I'm going to be talking about have been brewing for many years, and they contributed to an increasingly fragile and unstable environment. And that instability has really been actually very visible, easy to see if you wanted to see it. We've had asset bubbles, we've had rising indebtedness, we've had rising trade deficits, we've had declining manufacturing employment, and we've had business cycles that have been marked initially by really quite sustained weakness, so-called jobless recovery. And then they've been followed by really rather, well, feverish booms. But yet everyone, and I do mean everyone here, investors, policymakers, economists, they all chose to ignore this evidence that I think in retrospect, well, I wouldn't even say in retrospect. I'm going to push a book of my own here. I wrote about this. Plenty of Nothing, The Case for Structural Keynesianism, and the last chapter of this book is called Recipe for a Depression. It was published 10 years ago. It was one business cycle too soon, but the arguments, when you read it, it was visible. Now, you might have to ask yourself, why was there this blindness towards these issues? Well, one reason I think is sort of simple ideological blindness. Another reason is that the people who do economics, who do policy, they get caught up in the same irrational exuberance as everyone else. They're people too. They're members of society. The policy problem today is that economists, I think, in Washington, places like the IMF, our own administration, is still refusing to address the real causes. And to me, the danger is not that we're going to have another bust. I don't think that's the way to frame the danger. The danger is that we're going to get trapped in an extended stagnation, that is, because that's the logic of the paradigm that exists. And that will cheat America's working families, it'll cheat our kids of a chance at shared prosperity. And that's why this is really important stuff. Now, the blow-up of the subprime market that occurred in August 2007 can be viewed as the detonator that triggered the crisis. And I think the crisis was amplified by policy failures like the decision to let Lehman Brothers fail. But the real bedrock of the crisis lies in the flawed macroeconomic paradigm that the US has pursued. The roots of that paradigm trace back to the late 1970s and early 1980s, which saw the triumph of neoliberal economics. At that stage, we put in place a new business cycle. Am I supposed to point this somewhere? Whoop. No, we lost it. Yeah. The old post-war World War II growth cycle was based on two things. Number one, full employment, and number two, most critically, a system in which wages were tied to productivity growth. That pairing created a virtuous circle of growth. The economic logic is that wage growth tied to productivity growth meant robust aggregate demand. Robust aggregate demand contributed to full employment. Full employment produced an incentive to invest. Investment then raised productivity, which supported higher wages. You had a coherent, consistent, virtuous circle of growth. After 1980, we created a new growth model that was marked by, one, a retreat from a commitment to full employment, and two, an amazing severing of the link between wages and productivity growth. And in place of the old model, we created a new growth model that was based on debt and asset price inflation. So borrowing and rising asset prices became the engine of growth, the engine of demand, in place of wages. Now, the foundations of the new model are two things: financial boom and cheap imports. Financial boom provided consumers and firms with the collateral to support their debt-financed spending. And that borrowing was also supported by financial innovation and financial deregulation. And that's where this whole financial deregulation story begins to fit into this macroeconomic puzzle. That's because the financial innovation and deregulation ensured a flow of products that could allow a persistent increase in the amount of leverage and a widening of the range of assets that you could collateralize and borrow against. Think of things like home equity loans. That's a classic example of that. Now, cheap imports had an important role too, because they effectively ameliorated the impact of wage stagnation, the problems of widening income inequality, and manufacturing job loss and insecurity. Cheap imports, in a sense, kept in place the political support for this model. And these features are visible in all the business cycles after 1980. I'm going to show you they're visible in the cycle of Ronald Reagan, they're visible in the cycle of Bush-Pair, they're visible in the cycle of Bill Clinton, and they're visible in the cycle of Bush-Feist. So this is an apolitical critique of what's been going on, as it were. Now, the change is particularly evident in manufacturing. Keep on going backwards. Why is that? Particularly evident in manufacturing employment. I'm going to ask you to focus here. What this does, this first cycle, we look at 1945 to 1980, and you look at the trough of each business cycle, October 1945, employment at the trough, and the peak of the business cycle, November 1948, and employment at the peak, and then the change in manufacturing employment over the business cycles. Well, look down this column. This is the peak of manufacturing employment at each business cycle, and you see an upward trend. Manufacturing employment through to 1980 is on an upward trend. And every business cycle, we actually add manufacturing jobs. Now, take a look what happens after 1980. Again, this is the peak of the business cycle, 81, 90, 2001, December 2007. Look what's going on. Before we had this trend with manufacturing, now we have this trend. Manufacturing is consistently dropping, and a remarkable break in the pattern. And worse than that, before we used to see every cycle we'd add to jobs. Now, in the last two business cycles, not only do we not reach our previous peak level, we actually lose jobs. This is a first. Bill Clinton actually marked a first. Over the entirety of the business cycle, we lost manufacturing jobs. And it got much worse under George Bush. Another feature of the post 1980 business cycle is the US goods trade deficit. Here's the trade deficit, again by business cycle peak year, measured as a percentage of GDP. Through to 1980, well, initially we have some small surplus after World War II, but then we're roughly running trade balances. After 1980, you get a massive, persistent acceleration in the deficit as a share of GDP, an explosion in trade deficits. And basically, these changes in the configuration of the economy, it really represents a change in fundamental policy attitude. Before 1980, the trade deficit was regarded as a problem. Why was it a problem? Because it represented a leakage of aggregate demand out of the economy. After 1980, policymakers do a complete U-turn. They sort of come to see the trade deficit almost as a semi-virtuous phenomenon. Why? Because it helps control inflation, and also because it reflects the choices of individuals in the marketplace, and that's supposedly good for the economy. Now, the new model is also evident in patterns of income distribution and income inequality. This is a favorite slide of EPI, the Economic Policy Institute. The bottom line shows compensation of your average non-managerial worker, non-supervisory workers. That's basically 80% of the economy. This is productivity. Up until about 1980, they're roughly tracking together. After 1980, they just blow apart. Productivity keeps rising, compensation basically stagnates. And so too, you have an incredible widening of income inequality. Again, tracking through the peak business cycle years. That's the share of income going to the bottom 40% of households. A declining trend throughout this period. Even the next 40% of households, they too suffer a decline, but albeit smaller. And then at the top, you see a rising trend. The share of households going to the next 15% keep rising. Share of households, income going to the top 5% rises even faster. And if you were to look at the top 1%, it's extraordinary. In fact, really, this is the poster child for it all. If you'd want to summarize what's going on, just look at CEO pay. CEO pay, though, is only symbolic. And I think this is, by the way, something that I think that we need to grapple with here. It's not enough to go after CEO pay. We've got a problem of going right into the pay structure. And how are we going to fix the pay structure? 1979, your representative CEO got 38 times what the average worker is paid. 2005, 262 times. In 2000, the peak of the Clinton business cycle, received 300 times what the average worker is paid. Okay, so that's the economic panorama. Now, what I want to argue now is that economic policy played a really critical role in creating these conditions. It installed a new neoliberal paradigm that basically weakened the position of workers, strengthened the position of corporations, and uncuffed financial markets to serve the interests of financial and business elites. And this new paradigm can be described by a neoliberal policy box. My friend Ron Blackwell at the AFL-CIO came up with this very nice metaphor for what's going on. These are the pieces of policy: globalization, the abandonment of full employment, small government, labor market flexibility. They create a box, and inside the box are workers. And basically, no worker can outrun that configuration of policy. If you're a private sector worker, you're hammered by globalization, you're hammered by the abandonment of full employment, you're hammered by labor market flexibility. If you're a public sector worker, you're hammered by the abandonment of full employment, you're hammered by labor market flexibility, and you're hammered by small government. What's going on? Well, when we talk about globalization, well, it's free trade and capital mobility, surely. But it's also, very importantly, something much bigger. The Washington Consensus that was exported by institutions like the IMF and the World Bank. They spread the whole neoliberal paradigm globally, multiplying its impact. Not only was it now at work within the US economy, but it was at work within the global economy. So that pushed countries to engage in things like deregulatory competition, that we talk about, sort of race to the bottom type outcomes. And more importantly, it caused wage stagnation, because everywhere workers were being subjected to the same policy configuration, and then you have wage stagnation in China. Everywhere, wages are not keeping up with productivity growth. We're therefore adding to supply, but we're weakening demand in the north and not adding to demand in the south. So you get the creation of global deflation. Small government is the attack on the legitimacy of government activity, and it also persistently pushes deregulation regardless of dangers. The labor market flexibility agenda is the attack on unions, labor market supports like the minimum wage, unemployment benefits, employment protections, employee rights. And the abandonment of full employment takes the form of putting inflation ahead of full employment and turning management of central banks and monetary policy over to those who place inflation ahead of employment. So policy was critical to destroying the earlier virtuous circle model and replacing it with this new growth model. And again, here the features of the new growth model are debt and asset price inflation and lower saving rates of households. And again, all of this is very clear in the data. This is a household debt to GDP and non-financial corporation debt to GDP. We have to strip out financial corporations because there's so much engineering, back and forth trading. Their debt is a sort of a wash. Look what happens to the household debt to GDP ratio. Through to 1981, fairly constant. It does rise a little bit. You'd expect that with some sort of economic development. 41% of GDP, 48% in 1981. 2007, it's jumped to 100% of GDP. Same is going on financial engineering and corporations. This is the non-financial corporations, the Caterpillars of the world, the General Motors of the world. 38% of GDP, 1960. 53% of GDP in 1981. 77% of GDP in 2000. Here's a measure of household debt service relative to household income. So that's what you have to pay in form of interest payments as a percentage of your income to meet your debt obligations. 10.9% in 1980, Q3 is quarter three. 14.3% in 2007, Q4. And it's really rather amazing because you have to remember what's going on. Not only is the ratio rising, but this is a time of declining nominal interest rates. Interest rates in 1980 was 16%. They're 5% here. So behind this is a staggering increase in the amount of debts that households are taking on. There's another slide that I like. I've gone and taken the Case-Shiller National Home Price Index and then broken it down into periods. And this is the home price inflation in these different periods. Average CPI inflation and the difference between what did I do there? The difference between home price inflation and house price inflation. What you see is our economy grows when we have home price inflation that is significantly faster than average CPI inflation. The one period where we have home price stagnation or only modest home price inflation is the one period when we enjoy extended stagnation. I know everyone is focused on here, this period. It was an amazing house price bubble, 10.9% per annum for 6 years is really rather amazing. But the point to get across is that we were already relying on it way back. We needed house price inflation in the late 80s. We needed house price inflation in the late 90s. We've been drinking at this well for a long time. It just got a bit out of hand here, and I'm going to talk a little bit more about that too. And here's the last piece of this model, the personal saving rate. Well, it actually rises a little bit under the old model. Households are earning enough to put aside a bit. 10% of income is being saved in 1980. We'll push it down to 0.6% in 2007. So what's going on? Basically, this new growth model is intrinsically unstable because it relies on, 1, squeezing incomes of workers, 2, squeezing the household saving rate, 3, raising debt levels, and 4, asset price inflation. And all of these processes are unsustainable. They can juice you for a very long time, but they will eventually fail you. You will hit a debt ceiling if you're growing so much faster than your income. You will push the saving rate to zero, leaving you little room to go below it. And you will create asset price bubbles that push asset prices out of whack with the fundamentals, and then the market forces will assert them. Now, the point is, and what's made this so difficult to address, I think all of this has been very visible for a long time. If you were looking at the numbers, you didn't need to run fancy regression econometrics. I mean, I challenge the other side to put together as coherent a story. The point is that it went on much longer than any of us believed possible. And that's where financial innovation kicks in, because it just kept this process going. That's where that's the real significance of financial deregulation. They kept the model going longer. In a sense, we were like the frog. Krugman recently used this metaphor. The frog in the water who gradually gets boiled to death very slowly. This was going on and on and on, and we refused to see what was happening. But the consequence of that, because this financial innovation and deregulation kept it going, when the implosion came, it pulled the entire financial system down. And though the model was always headed for stagnation, we've ended up with an incredible crash as well because of the debt that was built up. And I want to talk to the next part of the talk. How does the flawed global economic engagement come in to fit into this? Well, I would argue that this model might have gone on for a lot longer had it not been for our flawed global economic engagement. Because our flawed global economic engagement created what I call a triple hemorrhage. We had a hemorrhage of leaking of spending out of the economy via imports. That's the traditional Keynesian leakage. We had a leakage of jobs offshore from outsourcing and shifting of production. And we had a leakage of investment offshore via offshoring of production. And this triple hemorrhage accelerated all the contradictions in the neoliberal model by further undercutting income and employment. And you see the root of this triple hemorrhage is the new US international economic trade policy that broke with the old model of trade. 1980 is a decisive break in our international economic policy. Instead of running roughly balanced trade, we begin to run those huge trade deficits. And instead of aiming to create a global marketplace in which we could export US production, we move to create a global production zone from which American firms can export to the US and from which they can also buy cheaper imports that replace US production. And there are three critical stages. You have to see this now as an opera. Each of the three acts, they all run together. They're not separate pieces of policy. Stage one is NAFTA. Stage two is the strong dollar policy that is put in place after the East Asian financial crisis of 1997. And stage three is China PNTR in 2000. All of these measures, by the way, were implemented under President Clinton, a Democrat, just to show that this is truly an apolitical critique. And they were implemented under the advice of Treasury Secretaries Rubin and Summers, who, by the way, as we know, still very influential. And what happened is they cemented a globalization model that had been lobbied for by corporations and their Washington think tank allies. And the great irony, though, this is the vicious part about it, is when corporations got what they wanted, the result was to actually undermine the neoliberal model at warp speed. What had been running into problems slowly, you're going to see a tremendous acceleration of the problems over the last 6 years. So step one is NAFTA. What did NAFTA do? I think NAFTA did four things, very important. First, it fused together the US, Canada, and Mexico into a unified production zone. Now, its importance is that it joined together developed and developing economies. We already had Canada and US fused together in the 1989 agreement. But now we put developed and developing economies together, and that establishes the template that corporations want. The second thing NAFTA did is it changed the significance of exchange rates. Previously, exchange rates mattered for trade. After NAFTA, they now matter for the location of production. This is a giant change. Third, very important politically, they changed the attitude of corporations to exchange rates. Because corporations who are now producing abroad now become in favor of a strong dollar because it lowers the price of their imported production and raises their profit margins on things that are sold in the US. And fourth, and unnoticed, is that NAFTA ended up creating a precedent for the strong dollar because the US accepted the devaluation of the peso after the Mexican financial crisis of 1994, which happened immediately on pretty much the day that NAFTA was implemented. So what were the results of NAFTA? Well, the first result was that the trade surplus with Mexico turned into a deficit. Until 1994, we used to run trade surpluses with Mexico. After NAFTA, we get staggering increases in the deficit, trade deficit. They increase all the way to 2007. And this pattern, look at that pattern. There's a break. 1994, when the agreement, I'm going to keep on coming back to this pattern. It's what it's all about. Second result of NAFTA is you get closure of manufacturing plants and shifting of production and investment to Mexico. Third result of NAFTA is you see very widespread use of the threat of shifting jobs to Mexico to suppress wages and batter unions. Next stage is the strong dollar policy that is put in place after East Asia. Well, let's ask what that was about. Four things again. Basically, the US followed the precedent that had been established in the 1994 peso crisis. What would we do? We'd make large dollar loans to the crisis countries, and we would let their currencies depreciate. This policy was now supported by corporations because they were looking to offshore and outsource production. This combination then created a permanent incentive for US corporations to downsize their manufacturing operations and increase their foreign manufacturing. And fourth, this new policy was supported by developing countries because it spurs export-led growth and it facilitates the attraction of foreign direct investment as the way to development. What were the results? Well, you see the trade deficit after 1998 just balloons with this tremendous appreciation of the dollar. The deficit just explodes. Now, part of it was indeed due to the strong economy of that period. We did have a dot-com bubble. We did have a stock market bubble. We did have housing price inflation, and that was driving the economy and sucking in imports. But that effect was amplified by the strong dollar. And one of the things that's really noticeable is that the US economy, manufacturing, actually went into recession in 1998. That's when US jobs peak in the 1990s, 2 years before the recession. And that's because of the response to the East Asia crisis and the continuing effects of NAFTA. You've got them both now working together in the late 90s. The third thing about this, third result of this 1997 response was it made the US consumer the global buyer of first and last resort. And that meant the global economy became dependent on the US economy, which explains why the global economy has crashed when the US economy crashed. I should say sort of here's another thing. Not just this is, again, the trade deficit with the Pacific Rim countries. So it includes China here. After 1997, you get a walloping acceleration in the trade deficit with that group of countries. Again, this is the strong dollar policy put in place after the crisis. So then we come to the third stage. Again, all of these pieces fit together. They shouldn't be seen as discrete pieces of policy. It is putting in place a new architecture for the global economy. And the third and final stage is China PNTR. Now, one of the interesting things is though NAFTA and the strong dollar policy after East Asia were clearly disastrous for the economy, business was still able to push through the China PNTR agreement in 2000. And that's because it took time for the full effects of these policies to come through, and their effects were being obscured in the late 1990s by the bubble that we had in place, the stock market bubble, the dot-com bubble, and the pretty significant house price inflation. And that created the grounds to push through this last piece of the the new architecture. China had always had access to the US market, but what China PNTR did was it gave China permanent access to the US market, which meant firms could now relax about investing in China. They were guaranteed access through the agreement, and they were guaranteed property rights because China signed on for the WTO and all those so-called property right provisions were in there. But it did so in an utterly flawed way. There were no effective safeguards and no defenses against China's exchange rate policies, and we've come to suffer for that very, very heavily. But what China PNTR did was it cemented, it's the final piece, the capstone, that cements the model of globalization that corporations want. And it does so by making China part of that global production zone. What were the results of this policy? Well, they were good for corporate profits. In this last business cycle, that's been the one feature of the business cycle. If you do a ranking of an analysis of the business cycle, pretty much all the indicators are the worst over the history of the modern business cycle, except for the increase in profits, which is the largest ever recorded over a business cycle. Has a disastrous effect on US manufacturing jobs and manufacturing investment. And of course, well, we've seen this before. Look what happens to the trade deficit. Basically, 83 billion when it's put in place. There's a recession here, so not too much change, taking time for it to adjust. And then the trade deficit with China just takes off. In 6 years, we basically triple the trade deficit with China. 256 billion in 2007. And we should also say that it has a negative effect on Mexico and other developing countries because China starts to siphon off foreign direct investment and manufacturing from those economies. So we can now sort of come to put the pieces together. Okay, remember how I sort of wanted to look at the flawed growth model, the flawed model of global economic engagement? How do they fit together? Well, basically, we created an economy, created a growth model that really needed bubbles. That's sort of the feature of the neoliberal model. The weaker the economy becomes, the larger the bubble that's needed. That's the pattern we see through the 80s, through the 90s. Flawed global engagement then devastated the economy and accelerated its weakening. That meant, in a sense, we needed the mother of bubbles, which really only housing could provide, to get growth going again. We needed a bubble, given this macroeconomic configuration, to restore full employment and growth. It took the full logic of this took a long time to emerge, and the chickens only came home to roost in this last business cycle. After the recession of 2001, the economy got stuck in a very extended period of jobless recovery, despite quite aggressive monetary and fiscal policy. Fears that we were about to slip into recession again pushed the Fed to lower interest rates to 1% and hold them there for a fairly extended period. That did indeed spur a house price inflation and a construction boom, and all of that eventually became a bubble that burst in the summer of 2007. Actually, the housing prices peaked a little bit before that. But the big point is that the bubble was needed to revive an economy. Without this, there would have been no expansion, and we might have fallen back into recession far earlier. The reason for the jobless recovery in 2001 through to 2004 is a combination of the hollowing of the middle class plus the triple hemorrhage that drained spending, manufacturing jobs, and investment. Again, the role of the triple hemorrhage is clear in the trade deficit and manufacturing employment. The goods trade deficit hit an all-time record high of 6.4% of GDP in 2006. The recession supposedly was over in November 2001. That's what the National Bureau of Economic Research Dating Committee says happened, when employment was 130.9 million persons. 2 years later, in November 2003, despite we're supposedly in a period of recovery now, employment was 130.1 million. We lost, over that 2-year period of recovery, we actually lost 800,000 jobs. Turn to the manufacturing sector, and over that same 2-year period, manufacturing lost 1.5 million jobs. Fact is, manufacturing just kept falling off the cliff. It started in 1998, after the East Asian crisis, a slow decline, and then an unprecedented continuation of declining manufacturing employment. Never happened in this way before over the entire expansion. I know with the Clinton expansion, we actually lost jobs over its entirety, but for much of the expansion, till 1998 actually, manufacturing rose. In the Bush period, the chickens really do come home to roost. We never get manufacturing growth. So let me conclude now. a last statement here. I want to say that despite the record low interest rates, this is sort of the crux of how much we needed this bubble. We had record low interest rates of 1%, and we had the biggest bubble in US housing markets nationally ever, and yet we still, despite that, we still had the weakest economic expansion in modern times. We had the weakest GDP growth over the last expansion in all the business cycles since World War II. We had the weakest investment growth in all the business cycles since World War II. We had the weakest employment growth in all the business cycles since World War II. We had the weakest manufacturing employment growth, all the business cycles since World War II. We had the weakest compensation growth, all the business cycles since World War II. We had the weakest salary growth, all the business cycles since World War II. That is overwhelming evidence that the economy needed a bubble. Mike, you're looking anxious. Do I have a minute more? Okay. So the ultimate cause of our crisis is our flawed macroeconomic paradigm. I think this data, this story, makes that pretty clear. The paradigm needs bubbles if the economy is to grow. Financial deregulation and financial excess facilitated the bubble. There's no doubt about it. But I would argue to you that they should actually be seen as part of the neoliberal paradigm. They were needed to fuel debt and asset price inflation, and that's why we promoted them over the last 25 years. So now we come to the policy conclusion. Fixing regulation and fixing the microeconomics of Wall Street's incentive pay and so on can help stabilize the system and can limit financial excess. But it does nothing to address the macroeconomic problems that I've been talking about. We need to change the paradigm. But as yet, I'm seeing no recognition of the need for change because there is no understanding of the problem. In fact, judging by its top economics personnel, I read the Obama administration as looking to maintain the system rather than to change it. Those in charge are in fact the same people who created the system. And now in my view, at best they're going to be able to jumpstart the system rather weakly. How might that happen? I think it might happen by creating another bubble, this time in treasury bonds. But, and here's the but, it will not deliver shared prosperity because this neoliberal model was never constructed to deliver shared prosperity. Problem number one. Second, I think though the economy will likely stabilize, I think it will be unable to escape the pool of stagnation. And that is because this neoliberal model is burnt out. And that means stagnation is the logical next step. Thank you very much.
Well, thank you, Dr. Palley. I was worried there that when you said there'd be another bubble in treasury bonds, there'd be a stampede by the audience out to call their brokers. You've answered the question raised to my mind by the Onion, the satirical newspaper, which a few months ago had a headline, "Investors Demand New Bubble to Invest In." Very provocative talk, and there's a lot of issues it raises. I'm sure a lot of disagreement, but I think the particularly interesting aspect of your case is something that even people who disagree with you are going to have to lay out. That is, we see all of these patterns starting in this post-1980 period. So there clearly is a pattern from 1980 to 2007. This is now a historical era. Mm-hmm. And however, whatever story you tell, you have to relate these things. The trade deficit can't be discussed in isolation from the debt increase, and the debt increase from the stagnation of wages and so on. So you've woven these together into a particular story. There might be other stories, but there is. They all have to address the big picture, which you've laid out so well for us. Questions, comments? Yes.
Hi, my name is Carolyn Poplin. I'm a physician. My question, I followed everything and I agree with everything except investment. You say their investment moved out of the country, but the country was flooded with money, a lot of it from overseas, that was investing in housing. And it seems to me there's something wrong with a capital market where the highest, best use of money for investment is lending it to people to buy houses. It drove up the price of housing, and it didn't go into productive capacity or increasing productivity or the things that that a macroeconomist would really would think would be the most important thing to invest in.
Yes, a good question, and something worth focusing on. The total statistics for investment show that there's poor performance. If you break the statistics down and you look at the composition of investment, what we see is a decline in manufacturing fixed capital formation and much more shifting to housing capital formation. So you're absolutely right. That's what did happen. But it's good to have houses. We don't want to have more than you need, and you don't want to create house price inflation that then creates tremendous problems. Either people can't afford to buy, or people pay over the odds and then lose huge amounts. We want to get back to housing being the provision of housing services and not being the provision of an investment vehicle. This is part of the problem. One thing I would caution you about is the confusion that often exists in the public between investment related to financial investment and real investment. What we need in this economy is real investment, the accumulation of productive capital that will produce goods and services, some of which we'll consume and a lot of which we'll export. That is distinguished from portfolio investment, which is what gets talked about, the Charles Schwab, Goldman Sachs type activity, which is buying and selling stock. They call that an investment, but it's just a trade between you and I that just rearranges ownership. It does nothing to actually increase the stock of capital in this country. We pay way too much attention to that. Our politicians don't understand this difference between trading stock and stock investments versus investing in capital. And they then, as a result of that, get confused and think of this other activity as investment and then get won over by Wall Street, and voters get befuddled by it. We need to get back to putting productive capital in place that's going to produce goods and services for us. And this macroeconomic configuration that I described now works entirely against that. And that's why there's a macroeconomic dimension to these problems.
Well, that's a good point. As long as I can remember, in the news, the two indicators of economic progress have been an increase in housing starts and the stock market going up. And this during a period when there was a massive misallocation of resources, both to housing and to the financial sector, as opposed to the traded manufacturing and agriculture sector.
Perhaps that's indicative of how little mentality change there has been. I mean, today, that's what Wall Street looks at. If the housing start number looks good, you get a bump in the market. If the Dow is up, people feel good again. Now, there is some substance to that. Yes, this is going to, a jump in housing starts probably does signal something about a bottom in the economy. And a rise on Wall Street probably is kind of good for people's portfolios and maybe people's confidence, but a limited sphere of people in my view. So I'm not going to say that those are bad things, but they become bad things when they distract us from seeing the more fundamental problem of how do we increase our investment in productive capital. And that's the challenge of the next 10 years. We've got to stop talking about saving, which leads us down an entirely wrong conversation. The saving conversation gets you into the hands of Charles Schwab and those guys. And we've got to start talking about investment. And I'll tell you a secret, a dirty little secret that's not out there. When I, as an entrepreneur or a manufacturer, build a plant, it's bolted down, I don't know, in Wisconsin somewhere, it is immediately, not only is it investment, but it's immediately counted as saving too. That's just a feature of accounting. So if you want to increase saving, increase investment. Don't start with saving first, start with investment.
Thank you. Norman Bailey, Institute for Global Economic Growth. I'm somewhat in the position of the last questioner, that is, I basically agree with everything you've said with one exception. There was certainly, after 1980, there was certainly no rhetorical abandoning of the goal of full employment. And after the recession of 79 to 83, unemployment rates were actually quite low until the recent Great Recession, or whatever you want to call it. Why, in other words, what do you mean by abandoning the goal of full employment?
Well, I think that there was, well, first point, if you only have one disagreement with me, let's keep it under the rug, and when you're talking to other people, say what a great paper it was and how much you agreed with me. You know, we should stick together here. Now, I do think there was actually an abandoning of the rhetoric of full employment and the substance of full employment too. You know, before 1980, full employment was always referenced as a policy goal. You could go to things like the economic report of the president, the Humphrey Hawkins Act, stuff like that. There was a lot of talk of trying to reach full employment. What happens after 1980 is you have this triumph of this idea of this called the natural rate of unemployment. The May rule, you may all have heard it. That's what begins to flood in to the policy discourse. Full employment is completely driven out of the academic discourse. There's no longer any mention of it. And what you have is an idea behind the natural rate of unemployment that the economy naturally gravitates to this natural rate of unemployment. And we won't call it informal employment, we'll call it a natural rate. If the economy naturally gravitates there, then there's no need for policy to do anything about it. We're going to get there anyway. And if policy can't affect the natural rate, because it is natural, then what's the point of having macroeconomic policy, and specifically monetary policy, try and go after an employment number? Instead, we should affect the thing we can affect, which is inflation. So all of policy attention starts getting directed to inflation, and inflation has been the absolute dominant focus of the Federal Reserve for 25 years. It still is. And so I would say that's how the retreat from full employment plays out. And now, if you even challenge that in any way, because we are so beholden to Wall Street, we've set up this structure of policy in which we're so beholden to Wall Street, it's very hard to see how we even escape that problem. But there was a genuine change.
But that raises the question of, with this break in 1980, how much of the subsequent policy resulted simply from the trauma of the hyperinflation of the 70s on an entire generation of policymakers. Obviously, there were interests that benefited from it.
Well, Mike, I'm really surprised to see you call it a hyperinflation. I call it a sort of a moderate inflation.
By American standards.
Even you could push the adjective to high, but hyper really, it was a high inflation, and there are lots of very good reasons to explain it. Particularly the oil shock was of an unparalleled magnitude, when oil was much more important in our economy. There were these lingering effects from the Vietnam War inflation, and there were issues of we were in a transition period where income distribution was to some extent under conflict. This is a different type of inflation from the type of inflation that the monetarists talked about, and yet we adopted the economics of Milton Friedman, which have proved to be totally, which just make no sense of the 1970s if you sort of adopt a sort of a historical lens. And that brings me to another point that also relates here, the power of ideas. Keynes talked about this, how what seem obscure, irrelevant things, the scribblings of a madman in academia somewhere, once they become part of the mindset, are taken over by policymakers, by politicians, then we become run by those ideas. And part of our struggle is to get a new set of ideas out there and to recapture the minds and imaginations of our political leaders.
Al Milliken, AM Media. I was curious, looking historically now on the debates of the 1990s over NAFTA, do you think there was something that Ralph Nader and Pat Buchanan and Ross Perot were saying in opposition that were important, or were they off the mark as well as the mainstream of Democrats and Republicans supporting it?
No, I think they basically got the economics right, but it took 25 years for it to happen. I don't think NAFTA alone could have done these effects. It needed these three pieces together. It needed NAFTA, it needed the strong dollar, it needed China PNTR, and the arrangement, it needed full globalization. So at one level, they exaggerated what NAFTA could do. On another level, they were prescient in seeing the trend, the roadmap that NAFTA was laying out.
Mark Gruenberg of Press Associates Union News. Let's go to the next step. The egg has been broken. How do we, in so many words, especially for working men and women who've been the victims of this, how do we put it back together again?
Well, in some ways, Mark, I don't want to answer that question, because I think that's actually one of the tremendous failings of the left. It is quick to put together long lists of policies. Let's do this, and let's do that, and let's do this. And until people understand the story, until people have the understanding fixed in their head, they're not going to buy those lists of policy proposals. I mean, I think I know what to do, but that's what I want to steer you away from today. I want you to understand the story and figure out how to tell your readership this story. I think they understand it. It's very logical, it's very coherent, it's very commonsensical. It fits with their everyday experience. But we need this to become the story of the global economy and the US economy, and replace the story of comparative advantage, and replace the story of Wall Street allocating capital in efficient ways, and replace the story of trickle-down and incentives and all of that that dominates everything. This is the story that we need to get out. This is the major story. And if we start going to the solutions, if people don't understand the story, the solutions will be left hanging out there without a foundation to them, and won't be plausible.
Yasmin Sadat from the World Bank. I would like to hear actually what you would recommend, or what is the ideal, because you compare the US system with the European system. Okay, labor is much more powerful, probably the distribution of income between labor and capital more reasonable.
Can we get this back up again?
Yet
You push me. Yeah, can we keep going? Keep going. Keep going. That's it.
Oh.
Well, here's my deal. If the box is the problem, we need to construct a new box. We're going to need a new globalization. Now, to me, it's going to need a new financial architecture. It's going to be about capital controls will be a piece of it. Exchange rate regimes will be a piece of it. New trade rules will be a piece of it. Maybe limits on surpluses that countries can run. Some way of getting out of this bad forms of competition and inability to adjust the global economy. We're going to need to restore full employment as a real goal, along with inflation. And that's a challenge for the Federal Reserve. I think that actually there's been drifting in this direction, strangely. There's a willingness now to talk of slightly higher inflation rates, because there's a recognition now that inflation has a beneficial impact on labor market adjustment. It greases the wheels of labor market adjustment. But that's going to be a big challenge. What happens if the optimal inflation rate in this country is 3% and not, the Fed has set it at 2%. My own view is it's always been 3%. That's what I was brought up on when I did my Phillips curve. And I used to write about this, in fact. I claim some precedents even beating George Akerlof and his colleagues at Brookings on why inflation greases the wheels of adjustment. Jim Tobin was my teacher of macroeconomics at Yale. We're going to need a different attitude towards government. We're going to have to accept that government, it's not market versus government, it's market and government. And that's the debate. What's that mix? We haven't gotten there yet. That means the place for regulation, the provision of public capital. There's a real important place for government. Some services that we currently produce in the private sector probably should be produced in the government sector. We've gone too far in one direction. We're going to need a different view about labor markets. Unions are not the cause of a problem here. They're an essential part of getting income distribution right. Minimum wages have an essential role in seeing that labor markets serve people. And then, in a way, if you really look behind it, if you think of a box, it's actually 6 sides. Get your geometry going. What's keeping this thing in place? Why doesn't a 4-sided box You'd slap it and it would fall over. No, there's some side supports to this. And those side supports are corporations and financial markets. We need to reform corporations, make them accountable. They exist by a privilege. Through law, they should serve a public purpose. Yes, they may make private profits, but is private profits serving a public purpose? And the same goes for financial markets. We need to take the speculation out of financial markets and see that they allocate capital in ways that are productive and not speculative, engaged in constant turnover, clipping here. It's like coinage clipping, except now that's the old days. It took a little bit of a side of a gold coin off or a silver coin. Now they're taking it off all of our investments, our 401ks. We're getting scammed, and they're doing nothing good for us. In fact, far from it. They control corporations to push corporations to work in undesirable antisocial ways. So that's it. You want to understand the solution? We repackage the box. We take workers out, we take American families out, and we put corporations and financial markets in. But again, no one is going to understand that unless you have a more coherent story. We need to control the economic discourse, and we are miles away from that.
Isn't there an international dimension of this involved in raising the wages of Chinese workers and of Indian workers? What you see in this decade is that at the very time that wages in the U.S. are not tracking productivity in the United States and in the first world, in China, the profit share of productivity growth goes up and wages stagnate as well. And I'd just like to elaborate on that, the problem of this global overcapacity where first world and third world developing countries are all trying to sustain wages for short-term competitiveness reasons. And at the end, that kills off the aggregate demand you need for these very industries that you're trying to promote.
That's a huge problem. And I would say that one of the things that I've learned over the last 20 years is that economists have got the problem of development pretty much back to front. Or at least economists are working in the problems of development of 50 years ago. They're not working in the problems of development today. The problems of development 50 years ago was that it was difficult to build up capacity. The problems of development today, it's not at all difficult to build up capacity. Look how China just within a decade grabbed a huge amount of the world's manufacturing capacity. We can build capacity quickly. It's no longer a problem. The real problem is to build demand. What is the social structure of an economy that builds a demand that is connected to the productivity of the economy, supports that, and comes out of that productivity so that it doesn't produce inflation, so it doesn't produce a misallocation of income? Those who produce get it, and those who don't, it doesn't rely on government to replace the shortage of the private sector spending. So your wage question fits right into that. And it's a huge problem. But one thing I can tell you is that if all the developing countries are putting in place the neoliberal policy box, because it's not just us that's doing it, then they're all headed in the wrong direction. And that's why we have a global demand shortage.
Hi, Kathleen DeBoer from the OECD. I also agree with a lot of what you said, but and like what Mike's saying, I was going to add the seventh piece of this box. I think whether we go with a treasury bubble or the improved trade regulation and changing some of the imbalances of the WTO, China's going to have to take a huge hit, one way or the other, if you're going to have any kind of a correction here. Would you agree?
China needs to rebalance its external accounts very significantly. There's no doubt about that. We need to. I think we're looking for a new international economic accord. I call it Bretton Woods 2, 3, whatever, but it will involve an exchange rate mechanism. Exchange rates are now probably there are two critical macroeconomic prices, interest rates and exchange rates. If you get those wrong, I don't care what you do at the microeconomic level, you will not enjoy prosperity. Now, both of those prices are now affected, are sort of in the international arena. You're going to need an accord to somehow manage those prices and see that countries can set them in a way that establishes prosperity. That means exchange rate reforms. It means some sort of new capital control reform. By the way, I think capital controls are an issue that we may want to think of. A lot of our problems have come from capital flows. I mean, think of the Japanese carry trade and what that did to the value of the dollar. You're going to need trade reform. Yes, there's going to be sort of a... But again, here's something I'd ask you all to take away. Stop talking about trade and start talking about globalization. Trade was the 19th century economy. Trade was the economy of the first 60 years of the 20th century. We are in an era of globalization. Trade is a piece of globalization, but globalization is far bigger than trade. What I have been talking about, NAFTA, East Asia and the strong dollar, China PNTR, is about creating a global production zone. That is what globalization is, a global production zone. It's not about trade, it's about production. And that's what we have to get our hands around. That's why we need the box that puts corporations and financial markets inside, because they are the places where they are the organizers of production. And unless you can control them in the right way, then you're going to have all the worst aspects of globalization in play.
Yeah, hi, I'm Mike Olshausen. The reliance on debt and asset price inflation to drive growth over the period you've talked about had some extraordinarily happy effects for a small group of people. And you haven't really, I think, underlined for us how very happy and salutary and wonderful that all was. I mean, it resulted in enormous fee income of all sorts, packaging things and, debt origination. That then could be sequestered in income, and once it's in your income, it's yours. And in the increase of wealth in a tiny portion of the population. The rest of the population is generally speaking not very well organized. Many political leaders come from the top 1%, or in that kind of, they certainly are able to permeate it and get into it. What's really to change any of that? There's no... That's so appealing if you're in that top 1%. And the ability of the top 1% to, in a sense, herd the cats or herd everyone is really quite strong. And this is true globally. There's very little that you can really do about that.
Well, just in case you think, I urge you to pick up this book, Plenty of Nothing. I am aware of it. I've written about it a lot. In this one policy brief where I'm trying to sort of help people understand the deeper dynamics, of which that is an outcome. And in the paper I do make some throwaway reference to this idea of plutonomy, the shifting of the income to the elite. But you've hit on a very deep political problem, money in our politics and how to get around that. I would say even more, it's tremendously powerful. That Wall Street nexus, it runs to Pennsylvania Avenue, surely, the White House, the Congress. It also runs to Massachusetts Avenue, where the ideas get controlled. And Massachusetts Avenue is a revolving door. When the Democrats lose, they go over to Massachusetts Avenue. When the Republicans lose, the Republicans go to Massachusetts Avenue and the Democrats go to the White House. I have to credit Rich Trumka with this one here. He talks about economic policy as being a case of having two waiters and one chef. We've got the Democrats and the Republicans, they're the two waiters, and then there's one group of economists. So you've got one chef, they're both serving the same food, the same policy food. That's what I'm trying to get at here. We need new chefs in the kitchen. The chefs are the world of ideas, and we have to take that very seriously, because our policies won't be serious otherwise, won't be taken seriously without that. And you're absolutely right. We're up against it in terms of the money, but actually I think money is. I'm not running for office, so folks who run for office are in a different ballgame. They need TV, radio, ads, etc. They need the money. But in the world of ideas, I think that this thing is ripe for the taking, and it doesn't need that much money. It needs brain power, and we've got plenty of that.
Well, our purpose is to introduce you to new chefs. You can find some of the recipes at newamericancontract.net on the web. Please join me in thanking Dr. Thomas Palley.